Hey, everybody. Welcome to the podcast. Thanks for joining me. Appreciate it. Here we are on Tuesday. The markets are closed, and as you can see, pretty green across the screen. Interest rates were up on the day. Volatility down on the day. The dollar was down. The euro was up. And, of course, all the major indices were up. Now, they were up higher, and, of course, now that we're having more people coming out speaking today, John Boehner spoke. Harry Reid spoke and said the deal is unlikely by Christmas time. After he said that, the Dow was about 115, 120 at the time. Sold off. It was up around 60, got a little strength into the close, and we finished up 78 on the Dow. Transports, who had been on the verge of breaking out, kind of flat on the day. Utilities, kind of flat after their big run the last few weeks. NASDAQ was pretty strong. Tech across the board was strong. Semiconductors, very strong. And mid-caps and small caps were strong as well. Small caps actually leading mid-caps. Financials also up on the day. So pretty much broad strength across the board. And we did have higher volume today than we had yesterday. It looks like it may be about 20-25% higher volume today than yesterday. And it was overall a pretty strong day. But we're getting to the point now where in the very, very short term, we're getting back, swinging the other direction where now we're overbought. And if you're wanting to buy something, depending on what it is, you may need to pause. All right, here's the S&P on the day. There's a 5-minute chart. S&P finished up 9 points, about 65 basis points. Pretty strong right out of the gate. Kind of moved in a real tight range most of the day. And then right here is where Harry Reid said that we would not, the odds didn't favor a deal done by Christmas time, which is what President Obama had said he was hoping for. Doesn't look like that is going to happen. So you see the sell-off and then a little rally into the close. But again, overall, from start to finish, pretty strong day. People can question why this is happening. Why is it going up? There's never short a dull market. There's that old adage. Part of this, I think, is on hopes that the Fed tomorrow, when they finish their meeting, Bernanke's going to speak, and they may buy another $40-45 billion of treasuries and so forth and bonds. And when they do that, they're supposed to, at the same time, sell other bonds to offset it. If they don't do that, then it's basically like QE, 3.5, 3.5, where they come in and they're doing another miniature round of new, fresh quantitative easing. So that could be what the market was trying to discount today, price in. But it certainly has been strong the last few days. So here's the S&P. You can see that run it's had, kind of paused right in here the last few days, and now it's broken out. Today was really a nice breakout. Did pull back a little bit. This was kind of the area a lot of traders were watching to see if we were going to break out of this downtrend, because it could have easily rolled over and headed back down. It broke out above, and you can see it's gone back up above the 50-day moving average and the 100-day moving average. So quite bullish. And volume has picked up as well. Now, some people are pointing to a head and shoulders right in here for those that are real technical. I think that's kind of a stretch, to be honest with you. I think when you look at these charts, you can make up all kinds of reasons for it. The market's a discounting mechanism. It's discounting that a deal will get done. It's discounting that in the last few months, things have seemed to have calmed over in Europe temporarily. And it's also trying to discount that the Fed may still be pumping more money in. And so up we go. And it was oversold. But now we're getting to the point, again, just as we were down here where I told you, if you're looking to sell stuff, wait, you'll get higher prices to do so. We now have those higher prices. This is the next kind of line in the sand. Are we gonna reach all the way up here? And I don't think that's out of the question. That's 1450. That's only another couple of days, or a couple of percent on the upside. So that's highly possible, but in the very short run, we are very stretched and we are overbought. And so now what's happening is the stock market seems to be setting itself up for a disappointment, right? It could be any disappointment. Ben Bernanke doesn't, continues with this twist and sells some bonds while he's buying others and not really putting fresh new money in. That is something that could cause the market to sell off, a buy the rumor, sell the news. The other thing is fiscal cliff disappointment. We actually go past December 31st and into January. One of the things that was brought up to me the other day is that many of these people believe that we will go over the fiscal cliff. December 31st will come and go without a deal. Why? Because all of the tax rates will automatically adjust up, right? The Bush tax cuts are going to sunset, and it'll adjust up. When that happens, then they can come in and they can initiate a tax cut. And now all of those politicians are on the record for a tax cut, not a tax hike. So even though they may be lowering rates from those, much higher levels, and rates could still go up from where we are today, they would get credit for doing a tax cut, not a tax hike, as if they were to do it right now. So if they were to vote on something today, they're all on record for tax hikes. But if they wait till January 1st, taxes automatically, by default, go up, and then they come in and do something a little less, still effectively raising taxes, but they're on record as doing a tax cut. Unbelievable, some of the semantics, and you would think, well, they wouldn't do that, would they? Sure. Sure they would. They're politicians. So that's something that could happen. And so what's happened is the stock market is running up right now and could be setting itself up for some disappointment later in the month. So again, you have to kind of play the middle here. You want to take advantage of this, make money while it's available, but at the same time, don't get lulled into thinking that this can't reverse and go down very quickly based on news-driven events. I mean, look, somebody comes out on television today, the market immediately drops 40 or 50 points. Underneath the surface, taking away the politics of this, the stock market has been gaining strength, and we still don't see long-term evidence of a massive rollover. In other words, a bull market becoming a bear market. We're not seeing that. Big caveat, this is a 3.5-year-old, almost 4-year-old bull market. So it's very long in the tooth. It should be, at the time where it should be rolling over, but we're not seeing any evidence of it yet. So the supply-demand picture that we look at, the medium term, still looks pretty good. But in the very short term, you have to wait here. You have to wait for a little pullback. If you want to average in because you have way too much cash, fine. But the thing is, again, keep the things that are income producing. That's very, very important. Whether they go up or down in value, you get paid constantly. And then do some trades. We bought some stuff down in here as an aggressive trade. We sold it when it reached this area. You can see the market's going up higher now, but we sold it right in here as kind of a risk-reward trade there. And then have some things that are just pure D investments. Companies that know how to manage. They are, doing special dividends or whatever they're doing, and they're selling more widgets, and they're doing it very effectively. If you mix all those things together, you'll be successful. You have a much smoother ride, and you won't get caught up in every tick of the ups and downs. All right, let's get back to Apple here because it's been very, very topical for really the last 2 or 3 months. So it went through this big, big decline. You can go back to prior podcasts. We talked about why it was probably doing that. But here's the deal. The other day I tweeted out that we're finally starting to get some positive divergences. And what that means is we have the stock has fallen, and it's fallen to the same level now as it was back, in mid-November, right before it made this run. However, when you look at a lot of the oscillators we look at and some of these momentum indicators, they're actually higher now than they were back then. That's called a positive divergence. That means the selling's not as intense now as it was back then. So I tweeted that out. Actually, I tweeted it out this day that the Apple had that big reversal, and then it had another couple of nasty days, and of course it had a good day today. I don't know if this is the bottom, but I would say that Apple is now in the bottoming process. Wherever that is, it seems to be in the bottoming process because what happens is very rarely any stock does it go down and go straight up and that was it. Typically what you see is a stock that will go down and almost make this W pattern that it's doing, which is pretty bullish. And this is what it could be doing here. But look, Apple probably isn't going to go back to 700 in very short order here. I think it is losing some of the mojo that it had the last several years where it was this, the default. The default for your money was Apple. You said, well, cash is paying me zero. The stock market's dangerous. But Apple, I put it in Apple and I can make, 20% in a month. I think that is starting to wear off a little bit. Obviously, there's been a lot of tax selling, which frankly, I don't necessarily understand. I understand that if you're wanting to sell it, doing it this year is probably better than January 1st. But just to sell it now, pay taxes on it, only so you can buy it back later, potentially at a higher price, doesn't make any sense to me. But people are doing it. Their tax accountants may be telling them to lock in gains, whatever the reason, it's happening. But Apple in general, fundamentally, again, I've said this before, I don't think Apple fundamentally is as good as it was 3 months ago or 6 months ago or 9 months ago. However, what you have to do is say, okay, it has fallen basically from this level up here. So it fell about 24%. Is it 24% less fundamentally good as it was back then? And the answer is yes. In other words, maybe it's 10%, or let's say it's 90% as fundamentally good as it was back then, but the stock's fallen 24%. So it's a bigger bargain now than it was at $700. Now there's some people who argue, well, they've got some issues with, are they a software company, or they're a hardware company, or are they a retailer? What are they? They're all the above, and they do all that very well. And I think they're going to have a great Christmas. Yes, there's more competition, but the thing was they changed the music industry, right? They came out with the iPod and changed the way we listen to music. Then they changed the way that our phones worked. Yeah, there were smartphones before. I used to have an old Trio. Do you remember those? TREO had an old Trio, big old heavy phone, but did all kinds of cool stuff. Then it was the BlackBerry, but Apple iPhone really took it to the next level. Then they came out and they basically invented the tablet. I mean, yeah, other people did it before Apple, but Apple made it, a household item. The next thing they're going to do is what? I don't know what. They know what. One of them's probably going to be a TV. We know that's coming. There's a lot of things that Apple's going to do in the future, I think. So it's not over, and it's still a relatively cheap stock. But if you're looking at it and saying, I think it's going to make 30% a year like it's been making, or 40% or whatever the numbers are, those days may be ending. It may be in this transformation now where the market's settling in here. But again, you have to view Apple as a trade or as an investment. If you're trading, it's been kind of fun. And if it pops up, there's going to be some people shorting it again, probably at the $600 level. That's fine. If you're investing in it, I don't think anything's wrong with it. The one thing I would say, and I said this last podcast, if you own too much of it, you're going to have to reduce it on the next rally, because this is a wake-up call for you. If you have 20, 30, 40% of your portfolio, and I've seen portfolios with that much Apple in them, if that's you, you have to reduce it and scale out to get to a reasonable level. That's just my opinion, but that's why I never own that much of any one stock. I don't care what it is, and Apple, to me, is still one of the best companies to own, but you have to reduce those holdings on the next rally and phase out of a little bit of it to get to a level where it's just like any other stock. Okay, it's just like any other stock. I should have just as much as any other stock, but should I own it or not own it? I still say own it, and I think it's in the bottoming process. That's where Apple's, but again, you have had this tug of war going back, and you can see it. The volume's been heavier, and you can see these big moves up and down, and it's setting up for a move higher, I think, over the next few days. And in fact, today was a good example. It didn't close at its high of the day, but it was one of the leaders, and it's obviously helping the whole technology sector. Kind of the pin action you get when Apple goes up, the Qs go up, and a lot of technology companies follow. I'll just leave you with this tonight, that you see oil been struggling here, and look, that's coming into the holiday season. This is good. This is if you're somebody out there that is bearish on the economy, and I think right now the economy, stepping back from oil for a minute, the economy right now, there are some things, if you look back, if we are in a recession, which there are some very bright economists that still argue to this day that we are in a recession right now. We won't necessarily know about it for a few months when we look back, but we're in a recession right now. And these are people that I respect and have no reason not to believe them. When you look at a lot of the data that we're looking at, I think it's a mixed bag. I think you can argue for a weak economy. You could argue for an economy that maybe is better than we thought it would be. If you were to go back to last summer, I thought it was a foregone conclusion we'd be in a recession by now. And I was wrong about that. I mean, last summer, things grinded to a halt pretty quickly when the debt downgrade came and so forth. And yet, the economy has been pretty resilient. We still need more jobs. The housing market has improved. So we've got these pros and cons and pluses and minuses, and it's mixed. There are certain things that are improving, and there's certain things that that aren't. But one thing that is happening is that, oil prices have been falling just in time for the Christmas season, and that's very bullish. That's a stimulus. So keep an eye on oil. I think two things that you need to be watching right now is oil, and you need to be watching the currencies. You need to be watching the U.S. dollar, because a lot of times when you're watching those two things, you can kind of see what the market's going to do. If the dollar's weak and oil's going down, that's very, very beneficial for stocks, and we're seeing that. But be careful right here. Again, in the very, very short run, the stock market is getting in that zone. I'd say it's in the top 10% of being overbought. It's not a screaming overbought like maybe it was in September, but it is overbought right now, and it's not it's not the opposite of the screaming oversold we had a few weeks ago. But it's at that point right now where you want to start saying, if I have any gains in something that is a very, very short-term trade, do I want to take it off the table? If I want to buy, I have to withhold a little bit and buy on a pullback. And I think that's where we are right now, because we're going to have a lot of news-driven volatility in the next few weeks. Hey, don't forget, keep the questions coming. You can go on there and reply right to the, if you're getting the emails for the blog, just reply right back to it. Don't forget, we're on Google+, Facebook, twitter.com/Carl Eggers, eggerscapital.com as well. Have a good evening, everybody.